Do cows drink?
Water.
Bingo. You're awake. 6 o'clock in the evening.
I
My
was like,
8-year-old tried that
milk,
with me,
but
and
I
I was
didn't. I didn't get
I
it
said
straight away
no.
though, right? I think if I said water straight away, then it would have been a bit more impressive. But it did give me a second to think about it though.
I got outsmarted by an 8-year-old. That's all I have to say about that. And on that, let's start the show today. And for those who just recently registered, just into our room, my name is Eamon Gebre. I'm the head of wealth advisory here at Sarwa, and I'm joined alongside my colleague Akshay Iyer, who's one of our senior advisors. Today, we're going to be talking about smart money moves, the 4 pillars of investing, where we're going to take you on a journey to help you better understand what are the best strategies to take to help you achieve your financial goals. Before we start, maybe a brief introduction about ourselves. I've been with the organization now just over 3 years. I've been in the region approaching 13, spent much of that with HSBC in their wealth management division. Prior to this region, I was in Canada, where I worked for a bank called TD Canada Trust, also a variety of different capacities, but most recent, I was a financial advisor. This is my area of passion. This is what I love to talk about with my friends, my family, and also with clients on an ongoing basis. So I hope to share with you my experience in helping you achieve your financial goals.
Thanks for the intro, Eamon, and brief introduction to myself, everyone. My name is Akshay. As I said, I'm one of the wealth advisors on the team here at Sarwa. My background is all in banking as well as wealth management. Started my career at the Canadian Imperial Bank of Commerce in Canada. And then following that, I worked for a British private wealth management company. Actually licensed and qualified as an advisor, both with the Canadian Securities Institute and also the Chartered Institute of Securities and Investments. And actually been working with Sarwa now just for the past, just over 2 years. And look, very passionate about what we're doing here. The company's goal is to try to democratize investing, to make it a lot more accessible, a lot more flexible, in this region. But I'm also a big proponent of financial wellness, financial education. I'm a firm believer that, you as an investor, the more knowledge that you have, the easier your investment journey will be. So yeah, very, very glad to be with you all tonight.
Thank you for that, Akshay. And so for those of you who are, first timers on these types of sessions, normally the way that we run these sessions is that we'll go through a few examples, best practices, and you're able to actually pose a question at any point in time throughout the presentation. We will be taking them up towards the end, but you don't need to wait until the end to pose the question. So I encourage you, if a thought comes to mind, any idea, and you don't want to lose that train of thought, feel free to just type it into the Q&A section. We'll be happy to take it up. And if we run out of time, we will also, respond back to your query. So please do put your name or your email address so that we are able to respond back to you. But otherwise, shall we?
Yes, definitely. Let's do it.
Let's do it. Smart Money Moves by Sarwa. First things first, just a few disclaimers. Our views today should not be interpreted as one-on-one financial advice. As you can imagine, every individual's circumstances are unique, and I would recommend in that case to have a conversation with a financial advisor so that they'll be able to better understand your current circumstances, your goals, and help give you a more bespoke solution to help you achieve your financial goals. Today is really more about best practices that any individual can apply at any stage of their life or any stage of financial circumstances that they may be in. Secondly, we cannot tell the future. And why that's important is that we don't have a crystal ball, and neither does anyone else, by the way, when it comes to how markets are going to behave in the near term, how particular stocks are going to react to certain market news or what market news to expect. Those things are impossible to be able to accurately predict, whether it be over the months or the many years. No one does. So without further ado, let's talk about Sarwa. Maybe start with there. For those of you who may have heard of us from friends and family, and you've been referred over to us, or maybe you may have seen some of our adverts, or maybe you were, sitting in a seminar that we were hosting with your employer. Sarwa is the region's leading investment and money management platform. Our aim when we first launched in 2017, and it still stands true till today, is to democratize investing by offering cost-effective, transparent, and easy to understand and use investment solutions for investors. All too often, there's a lot of barriers, which we're going to get into in a bit, when it comes to taking that first step when it comes to investing. We've realized that when we first started that there was a market need for cost-effective solutions where you're able to get in at a very low cost and also low barriers to entry, low value, versus having large ticket sizes. Also, a lot of investors just don't really understand what they're being offered or what they're investing into. So this was a need in the market that we identified and that we've been meeting for the last 5, approaching 6 years now. Since we started with one proprietary solution, which is our robo-advisory service. But since then, we've grown to offer many different solutions for all the different needs that you may have from an investment perspective. So we now have become a one-stop shop for all your investing needs, whether it be investing, trading, crypto trading, or just having a deposit account to earn the highest rate of interest. We have a safe product as well too. We are a regulated entity. We're regulated through the Dubai Financial Services Authority and also through the Financial Services Regulatory Authority, which commonly are known as DIFC and ADGM. And we're also backed by top regional and international players, some of which are private entities such as Shuruk, such as MEVP, 500 Startups, Phoenician Fund. These are all VCs that support and back shareholders in Sarwa, but also through semi-government entities such as Mubadala and the DIFC Fund. These are also participants and shareholders in Sarwa. Now, going back to that need that we started to address back in 2017, we learned early on that many of us don't have great money management habits. Unfortunately, it's something that wasn't taught to us when we were in primary school, high school, or even in university, regardless of what your focus, study focus would have been. I speak to many finance, majors, masters who still don't quite grasp the concept of money management because it wasn't something that was taught to us. As a result of not having enough knowledge on how to manage our financial affairs, many of us tend to start a lot later than we would like, because most of the time we don't know where to start. We're inundated with a lot of information and a lot of avenues and a lot of options that are available to us that we tend to get information overload. And also, for those who are actually brave enough to take that first step, they realize very quickly that a number of investment solutions within the region tend to be a lot more expensive than they anticipated. And I just wanted to let you know, they are, relative to other markets around the world, whether it be North America or Europe. We unfortunately do pay a premium in this region, and it's only a handful of providers who are able to give you competitive prices similar to what you'd find overseas. So this causes us to procrastinate. We kick the can further down the road. We'll say, we'll take care of this tomorrow, next week, next month, next year. And as a result of procrastination, we end up not saving enough for our goals. Surveys have actually been conducted. There was one major consultancy in the region who just did a survey recently and identified that 61% of the people in the UAE have no long-term savings at all. And it's precisely because of these reasons that we just highlighted. So how do you overcome them? So we know these are the challenges, and these are challenges that majority of us face. How do you overcome them? Well, to that, we say follow these very simple tactics, best practices, strategies, rules, if you'd like to call them. And the rule number 1 would be start now, yesterday, if possible. Here and before you, I wanted to show you a little chart that highlights the financial life cycle that a typical individual would go through, and the milestones that most of us will go through throughout our financial life cycle. And what this chart is highlighting is on the left-hand side on the x-axis, or sorry, that's y-axis, that's highlighting the dollar sign, which represents essentially the income levels, right? So $1 sign means less income than $2 signs, and then $3 signs means more income than $2 signs, right? And on the y-axis, you've got the age, essentially, right? So 10 years old, 20 years old, 30 years old, all the way up to 80 years old. And what this is essentially highlighting is that typically from the point of birth until about your mid-20s, you're not accumulating any income at this stage of your life. In fact, it's actually labeled from a financial planning perspective, early childhood and pre-accumulation. You are an expense for your parents or your caregivers at that point in time. And until you finish school, you're likely not going to be working or in a capacity to work and start earning any real income at that point in time. So mid-20s, you start your career, you get your first job, eventually you go on to your second job. And it's about when you get to your, I would say, early 30s to almost mid-30s, where you start thinking about, hey, I want to buy a house. It's always been an ambition of mine. That's something that I want to think of, I've been thinking about for quite some time, and you go ahead and do that. Many individuals also start thinking about marriage, also start thinking about children. The period of time between age 30 and 50, there are a number of changes, whether it be from a career perspective, expense perspective, milestones perspective, that, it's a very busy period of your life. So two key milestones that typically come up in conversations that actually I have with clients, and I would say universally most people tend to identify with, is a house purchase, and eventually when your children get old enough, university fees, subsidizing the university fees. It isn't until you get to the stage of your early 50s where you're a little bit more independent. You're an empty nester where your kids have likely gone on to, get jobs and maybe have moved out of their home. And this is a time that you can focus on building up on a more aggressive basis that retirement pot that you need, because retirement is literally right around the corner. So from age 50 to age 60, this is a period of growing and managing your wealth so that when you achieve that age of retirement, which is typically 60, you have a nice little nest egg that you can live off of for the rest of your life. Now, looking at this chart, it's very beautifully done in that it shows you a very smooth line and everything is working as per, theory should be working exactly like this. Now, you and I both know that life doesn't always operate in this manner itself. Well, one of those variables I think everybody needs to take into consideration is inflation. Inflation is something you've probably heard about quite often, but maybe haven't really understood how much of an impact it makes in your ability to achieve your financial goals. But inflation, if you want to think about it this way, it's that silent pickpocket that's taking money out of your wallet year after year without you even noticing. Inflation eats into your purchasing power, right? You may not see it represented in figures on your bank account statement or in your savings account statement, whatnot, because, you look at $1,000 today, hey, I still have $1,000 tomorrow. But the reality is that the purchasing power is diminishing. So, for example, let's assume you have $1,000 today and you leave that $1,000 in a current account for the next 10 years. The purchasing power of that $1,000 after a rate of inflation rate of 2.5% is actually about $720. Things get more expensive. That $1,000 just does not stretch as far as you expect it to go. House properties values, same thing as well too. A typical house today, let's just say you're entertaining a home that's worth $650,000, and your goal is to be able to purchase a house just like this in 10 years' time. Well, in 10 years' time, just assuming a 3% growth rate, you're looking at $873,000 just to have enough to be able to purchase that same type of home that you saw today. University fees, $150,000 for a typical undergrad program in the US. Well, in 15 years' time, assuming your little ones are 3 years old or 2 years old at this point, and you're thinking about saving for the long term, you need to save up a little bit more than 150, because just assuming there's a 3% rate of inflation being applied to university fees, you're going to need $223,695. Retirement, it's the same idea altogether. $5,000 a month today is equivalent of $9,000 a month that you need in 20 years' time. In summary, we are impacted by variables that we have very little control on that make it difficult for us to achieve the financial milestones that we have in mind. And as a result, we're essentially forced to make our money work through avenues that are available to us as hard as possible so that we can achieve their financial goals. Let me go to the next slide and I'll show you a little bit more and elaborate on this. So as I said, we're kind of forced to find avenues to make our money work as hard as possible for us. Well, what avenues are available? And these are all going to be very second nature to most of us. We can invest in real estate. That's a very popular option within the region and on a global scale as well. We can invest in land. We can invest in a friend's business. We can start our own business. We can invest in cryptocurrencies. There's a number of different avenues that you can pursue to help make your money work as hard as possible for you. One avenue that we focus on at Sarwa, and we believe is the ideal avenue for most individuals to I would say to take advantage of, is investing in the stock market. Why? Well, the stock market operates on two levers. And if this makes sense, it's a lever that I'm pulling down like this and up. It operates on two levers to help you achieve your financial goals. Number one, when you purchase a stock, there's a hope that it's going to appreciate in value. So we're talking about capital appreciation. So you buy something for $1 and you hope it increases to, let's say, $2. That's capital appreciation. The second lever that is a benefit to investors in the stock market is dividend income. Dividends are payments, and most of which are in cash, and sometimes in some cases also in stocks, by publicly listed companies to reward investors for putting their money, your money, into their venture. So take case in point, you invest in Pfizer, right? And you're hoping that there's going to be a capital appreciation in that Pfizer stock that you purchased. But meanwhile, regardless if there's any market appreciation or not, you're rewarded by investing in Pfizer. If they declare a dividend, you will be receiving that dividend income because you are a shareholder. The combination of these two levers are essentially how you develop growth over time. These two levers have been responsible for the greatest generator of wealth in comparison to any other asset classes you can think of. If you compare other asset classes, real estate, land, business, whatever it might be, pound for pound, the stock market has been the greatest generator of wealth for individuals. Now, I would not blame you when you think of the stock market and you think of risk, because you know what? Near history, near recent events have actually, shown themselves to be quite volatile. Let's look at 2008 financial crisis. We saw the markets drop from the peak of about 2,200 down to just under 1,100. We're looking at about 50% drop in a very short period of time because the world was going through a financial crisis in 2008. 2020 or 2020, we saw a similar, but not as drastic drop in the market. However, it was a very short duration where we saw the markets drop by about 30% within a given month. And we also saw a very quick rebound as well, too, for those who were in the market during that period of time. But this is what a number of investors, especially first-time investors, think of when they're thinking about taking their first step of investing in the stock market. To that, I say there's some good news. If we look at the next slide, I wanted to highlight to you that sometimes it's about vantage point. It's about taking a step back and looking at the bigger picture itself. Zoom out a bit, because then you get the whole story altogether. What you see before you is a chart that tracks global markets all the way from 1925 till present day. This particular chart is highlighting to you what inflation, the average rate of inflation has been since 1925. It's also highlighting what the treasury bills yields have been on average since 1925. It's also highlighting to you a bond portfolio, how it's performed over time, including various stock markets around the world, whether it's a US stock market, international stock market, growth portfolio, and income portfolio. You will notice there's a theme, and the theme is that, hey, volatility is inherent to investing. There have been periods of time, throughout history that have been quite catastrophic, that have impacted the stock market. When we look at the Great Depression, World War II, Korean War, Chernobyl disaster, the Gulf War, for those who were in the region, experienced that. We saw the subprime crisis or 2008 financial crisis. We saw 9/11. We saw the dot-com collapse. We saw the Iraq invasion. We saw COVID. We saw more recently the Russia-Ukraine war. But guess what? Volatility is inherent to investing. And despite the downs, our ups and downs, we tend to see the second theme, which is that markets have generally risen over the long term. Let's take case in point the US stock market. Had you been alive in 1925, and suppose you put $1,000 away, which would have been a lot of money, by the way, in 1925, after a period of nearly 70 years, that $1,000 has grown to $12.3 million at an annualized rate of return of 10.3%. Annualized return rate of 10.3%. And that's in spite of all the financial instabilities that you would have seen throughout the market. Whereas if you're an individual who just essentially sat in the savings account for that entire period of time, the T-bills would probably be the closest, I would say, in returns to a savings account. They're probably a little bit more generous. At that point, I can't even see it. I think it was I can't see very well in this chart here, but 3.6% is what the average rate of return has been. Well, your $1,000 then would be $29,580 today. My point being is that it is a rewarding venture. to go into the stock market, to think long-term, and to start as soon as possible. Now, you might ask, what's the best way to start? Okay, I understand, I acknowledge, I want to get into the stock market. I'm ready and I'm roaring. What do I need to do? To that, I say, okay, let's pump the brakes a little bit. Let's take it step by step, right? And similar to, when you're building a home, the foundation of financial planning is essentially having a goal in mind first, making sure that your debt is under control, and lastly, that you have emergency reserves in place before you start your investing journey. When I say goals, it's an intangible, I would say, item that it would, tangibly add a lot of value to you. Have a goal in mind of what you're working towards, right? Because what it'll do is it'll help you stay focused. It'll help you keep you on track. It'll stop, I would say, wandering eyes into other investment avenues, because what tends to happen in that case, it's human nature, is that something shiny and exciting comes around, or somebody taps you on the shoulder and says, hey, do this and do that. And you end up running in circles. You don't really make any progress towards your goals. A focused approach on a particular goal and having a strategy to help you achieve that goal that you review on an ongoing basis will be a very, I would say, good habit and very good discipline approach to investing. Number two, I would say, when you think of a goal, it helps to quantify it. How do you know how much you need? Well, there's tools to help you do that. Retirement calculators, you can find a number of them online on Google, but guess what? You could also find it on our Sarwa website. If you just go to the top right-hand side under Discover, there's a tab, it says Retirement Calculator. Have some fun, play around with it. You'll be quite surprised with how achievable, your goals could be. And if an individual wants to have a little bit more in-depth analysis from a financial planning perspective, that is a service that we offer to premium platinum customers here at Sarwa. Lastly, you can also help yourself, calculate, what you need or quantify what you need through the goal calculator, which is actually built right into your Sarwa dashboard. So you can put whatever goal that you have in mind, quantify that goal. It'll work backwards to tell you, hey, if you do this, you have, the probability of achieving your goals. No debt. It goes without saying, look, there's good debt, there's bad debt. And what we're talking about specifically is bad debt. You want to try to keep that under control, try to eliminate that as much as possible. I definitely don't recommend leaving balances, carrying forward on your credit card month on month, because the average rate of credit card interest in this region is north of 40%. My bank charges me 44% if I have a balance carrying. So I do recommend definitely to pay that off as soon as possible. And lastly, the emergency savings. Strongly recommend having at least 3 months to 6 months equivalent of reserve set aside before you even think about starting to invest, because it's good to just have that cushion in the event that there's a personal emergency, of course, unannounced, that may occur. And rather than relying on your investments to fund your emergencies, it's best to just have emergency money set aside. So this is the pillar, and I apologize for spending so much time on it, but as I said, it's a most important part of your financial plan, is to have this in place. Once you have this, then essentially you can start building. And the best way to start building is, hey, I've got a little bit more than I need in my emergency reserves, and that money's kind of sitting idle and I don't have any plans for it. Well, guess what? It's a great option to invest that as a lump sum. I'm going to go into a little bit more details on lump sum and what the impact is, but essentially that's a really good approach, is to invest on a lump sum basis with any excess cash that you have. And following that, and this is where you get that roof, on the chimney and whatnot on the house itself, is to supplement your investment with a monthly contribution. Most of us get paid on a monthly basis here. I think it only makes sense that you invest on a monthly basis. Every month you have the opportunity and chance to work towards your goals. So what better way to do that than on a monthly basis? And why is that so important? Let me go to the next slide to show you the impact of a lump sum deposit. Suppose you had $100,000 today, and this is the budget that you have, and maybe you don't necessarily have the capacity to invest every single month. Well, let me tell you that if you just deposit $100,000 today, and assume that you have a 30-year timeline, assume you invested and you received a 7% annual growth rate. Don't forget, you receive dividends. And typically, on average, equity, ETFs typically pay about a 2% annual yield. You get that as well too over time. Your $100,000 equates to a portfolio value of $1.3 million in 30 years' time. Just by taking that simple action 30 years ago and just leaving it invested and letting the market basically dictate what the outcome is, you would have a portfolio value of $1.3 million, most of which is through capital appreciation, but you have that nice little sprinkle of dividends, which equates to about $270,000, just by taking that initial step and thinking long-term. Suppose you wanted to take a step further and you do have the capacity to invest on a monthly basis. Well, guess what? Investing on a monthly basis, if we can go to the next slide there, Akshay, if you don't mind. There we go. Thank you so much. Suppose you had the capacity of investing $1,000 a month and you were able to maintain this discipline for the next 30 years. Well, that $1,000 essentially means that you've made a contribution, principal contribution of $360,000 in 30 years. So add your 100,000 plus the 360,000, you've made $460,000 in contribution, but your portfolio has grown to a value of $3.1 million, or just almost $3.1 million, most of which, again, are capital gains. But look at your dividends, $586,000. Ladies and gentlemen, it pays to start early. It pays to, start thinking about this at an early stage. The sooner that you do it, the better off you will be down the road. There's no better time than yesterday. And on that note, I'm going to hand it over to Akshay, who's going to be talking a little bit more about, okay, I'm ready to go. What do I need to do first?
Great, Eamon. Thank you so much for covering, rule number one and the importance of starting now. So look, I think people in the audience, they know that it's important to start now, but a lot of people are probably asking, what is the right vehicle to invest in? What's the right investment? Is it stocks? Is it bonds? Is it real estate? And our advice is always to have a diversified approach and actually invest in all of them. But before going into all of that, right, what is diversification? And what we wanted to do is, I guess, highlight what diversification is and, maybe bring it back to something that's a little bit more relatable for some people. Now, as a concept, right, diversification in investments, it's a strategy that really just involves spreading your risk across different asset classes to really reduce risk. But the principle is actually just based that, not all investments are going to perform the exact same way at the exact same time. And by having a variety of different investments, you can actually mitigate the impact of poor performing assets in an overall portfolio. But let's draw a parallel, right, between diversification in investments and the scenario of a shop owner and a farmer. So let's look at a shop owner, right? Imagine a shop owner who only sells one type of product. And let's assume, that product is computers. And, if the demand for computers suddenly decreases overnight as a result of market changes or, technological shifts or whatever it might be, the actual shop owner's business has the potential to suffer quite significantly. Now, to reduce the risk associated with just relying solely on computers, the shop owner could actually diversify, right, their product offerings. And they might sell other electronics, they might, have accessories, they might even have, non-electronic items. But the whole point is, by doing this, they're going to be less vulnerable to the fluctuations in demand of just that one single product. So that's the analogy of a shop owner. Now let's look at it, on the perspective of a farmer, right? Let's consider a farmer who grows only one type of crop, right? Let's assume they only grow grains. If there's suddenly bad weather that impacts, crops and grain in particular, the market prices could drop and the farmer's income is severely impacted. Now, to reduce this risk, right, the farmers can actually diversify their crops. Instead of solely relying on grains, they can look at legumes, fruits, vegetables, whatever is suitable for their region. And this way, same as the shop owner, that farmer is now less exposed to the specific risks that are associated with just growing one single crop, such as grains. Now, in both of these examples, right, the key idea of all of this is to spread out your risk, right? If one product or one crop faces challenges, the diversified approach helps ensure that the overall business of the farm is not overly, affected, or the shop owner, it's not actually affected. But very similarly, in investments, diversifying across different assets, such as stocks and bonds and real estate, commodities, all of these different things can actually reduce the impact of poor performance in just one investment for the overall portfolio. So now I hope that kind of covers what diversification is. And as I said before, right, our approach, our recommendation is always to take a diversified approach to all of your investments, right? By that, we mean don't put all of your eggs into one basket, right? It's important to spread your risk across various different asset classes, different markets. It reduces the risk, but also actually doesn't affect the portfolio's return. And these two charts, I think, really help illustrate this quite well, because we've got the chart on the left is looking at asset classes, right, between the year of 2017 all the way up to 2022, right? Every single color over there represents a different asset class. For example, orange is cash, light blue is large cap stocks. And really what this chart is highlighting is that every single year there was a different top performing asset class, and different winning asset class. So if we just look at, let's take an example, right? In 2017, the top performing asset class was EM, right? You can see that over there. EM stands for emerging markets, performed at 37.8% in 2017. That is some amazing performance, right? I would be very happy if I was investing in emerging markets. I'm sure everyone else would be. But if we go along the journey of the emerging markets, right? 2017, top of the pack. Now in 2018, emerging markets was right at the bottom, right? Negative 14.3%. In 2019, picked up again, 18.9%. In 2020, picked up, a lot more, right near back at the top again. But then in 2021, emerging markets was right at the bottom, right? 2022 raised a little bit more, but basically a lot of up and down for any of these individual asset classes, right? And I just took you on the journey for emerging markets, but if we look at any of the other asset classes, you can kind of see that the colors are very different on a year-by-year basis. And the reason for that is because there's never just one consistent top performing asset class. Now, if we look at the chart on the right, international stock markets, this chart is doing the same thing, but it's just looking at international stock markets and how they performed from 2017 all the way up until 2022. And, very similar, when we look at the top performing international stock markets, we're not just seeing one, right? You're seeing, Austria in 2017, you're seeing Finland in 2018, New Zealand in 2019, Denmark in 2020, Austria again, surprisingly, 2021. And, it's kind of changing quite a lot on a year-by-year basis. I think if you'd ask any top economist, any analyst, in 2020, if they thought that the Danish stock market was going to be the top performing in the international market returns, I highly doubt that anyone would have predicted that. But really the point is, it's very, very difficult, right, to select a winning asset class or market or sector on a consistent basis, on an ongoing basis, right? You might get lucky once, but the reality is it's very, very challenging to do on an ongoing basis. So that said, solution is to diversify, spread your risk, invest in all of these different things, because in the long run, that's really what's, going to help you achieve significant growth. And a lot of people are probably asking, look, how do you actually, how do you diversify? What is the solution for that? And there actually is a really good solution, which is an exchange traded fund, or, an ETF, which some of you might have heard of before. Now, an ETF is a basket of different securities, all bundled up into one fund, right? It covers, different, geographies and sectors, asset classes, all of these different things. You can actually have the ability to have, thousands of different companies all in just one fund and own them in a fractional basis, which means that, with as little as, $5, you can technically own hundreds of different companies. Now, the example I have over here is an ETF called IEFA. It's a developed market ETF by the biggest asset manager in the world, BlackRock. It's also featured in, our Sarwa portfolios. And this gives you exposure, just this one ETF that's featured in an even more globally diversified portfolio, gives you exposure to all the different sectors. So, financial services and healthcare, consumer staples, information technology, all of these different types of companies are all included in this ETF. But not just that from a sector base, it's also covered. It also is diversified on a geographical basis. So you're getting exposure to, countries such as Japan, the UK, Switzerland, France, Germany, and so on and so forth. So, utilizing tools such as ETFs are so important because they allow you to diversify. And, you as an individual don't need to do the work yourself, right? If you're if you're an investor, trying to actually construct a portfolio by yourself, and you're having to buy, thousands of different stocks and monitor it and continuously actually change them. Number one, it's going to be very, very expensive because, some individual stocks trade for, hundreds and thousands of dollars. But not only is it expensive, it's also very, very time consuming and laborious, right? Because you have to constantly choose and churn, your portfolio. So that's why exchange traded funds are fantastic tools to diversify. So that's really, I would say the importance of diversification, right? We understand that it is important to reduce your risk, but also to enhance your returns. So that's everything for rule number 2. I'm going to pass it back over to Eamon to cover rule number 3, which is all about lowering your costs.
Thank you for that, Akshay. And just a quick reminder to everyone, if you have any questions, please do not hesitate to type them into the Q&A section. You do not need to wait until the end of the presentation to ask your questions. So feel free, and we're going to be taking them up towards the end of the presentation. So we're at the midway point right now, and I promise you it'll go a little bit faster. So I don't want to keep you everyone from your dinner. Lowering your costs. And we're not talking about budgeting. I know that's probably what everybody thinks as a default, and you wouldn't be wrong to think that. In this case, we're talking about lowering your investment costs. I mean, let me ask you a quick question, Akshay. Is it okay to just throw money away?
Definitely not.
So if you found 2 investment providers who offer you the exact same solution, but they have 2 different pricing, one is much more expensive and one is cheaper, is it okay to pay more in any circumstance at all?
I mean, no, I don't think so.
That's always a rhetorical question, to be honest with you. It doesn't make sense to pay anything at all. And the problem is when it comes to investments, there's no uniformity. There's no status quo of how much something should cost. As I said earlier in the conversation, earlier in the presentation today, that there are, other markets around the world which offer similar investment solutions at a much more competitive price point versus, solution providers here in this region, even though they're exactly the same. It's important to take note of what you're paying for because there is an impact, right? Let's suppose that you started with a $10,000 investment and you found a provider who's willing, just because they really like your smile and they like your face, that they're willing to let you invest free of charge, no expenses whatsoever, whether it be the company that's managing your investment or the actual investments themselves, there's no charge. In this hypothetical scenario, assume again, 7% return, 30 years, your $10,000 would equate to $76,000 portfolio value. Since you have no investment expenses, that's all yours to keep. But let's look at what the picture would be if you were paying 1% in fees, all inclusive. That 1% over a lifetime equates to $18,700 in fees. Your take home is $57,500. Not bad. You get the lion's share of the returns themselves. And in fairness, there's no such thing as, a service is being offered for free. There's always a cost in some shape or form. Businesses exist in order to generate revenue and a profit. So it's expected to pay for, services. So in this case, they've done a great job. You've managed to, make quite a bit of money. You get to take home the lion's share of it. And the fee of $18,700 will go to the firm. Let's look at the scenario of what it would be if you were to pay 2%. At 2%, the fees over that timeline equate to $33,000, and your take home is $43,000. We're looking at almost the equivalent level of your earnings in fees. Now it's like, wait a minute, 2%. It's just 1% more than the previous example. Well, let's look at 4.5%. At 4.5%, you spend more in fees than what you actually earn. In this example of 4.5%, you're paying $55,000 in fees over that 10-year, and your earnings are $21,000. And I know some of you might think, who would ever pay 4.5%? The unfortunate, problem is that sometimes some of these investment products are so convoluted and so complex, and the terms and conditions are quite difficult to understand that you don't realize that you're paying 4.5%, and unfortunately, you learn all too late. So to help you, better understand, and what we'll do is we're going to skip the next slide because I think the example kind of already, sets it about the importance of paying attention to fees. I think what's important is learning what to ask. And if we can go to the next slide, actually, if you are speaking to an investment provider, if they don't proactively tell you what your fees are going to be, then it's important for you to ask. Similar to if you were to go to a car dealership, hey, how much is this car? What are the fees going to be all in? How much is the value of this house? How much is whatever it might be that you're thinking about buying? You should take the same approach when it comes to your investments. And a few questions that you can ask are, hey, this investment that you're recommending to me, what's the expense ratio of the fund itself, right? What's the management expense ratio of the fund itself? Hey, you're providing me a service as financial advice. What are you charging me and how are you charging me? And that's probably another one, maybe as a follow-up question. Are there any entry fees? So am I expected to pay a fee to start my investment journey? Are there withdrawal fees if I should exit from my investment? Are there exit penalties? And I know that might sound the same, but you leave it up to some institutions to differentiate between the two, which gives them the opportunity to charge you two separate fees. So it's like fees on top of fees, even though you're doing the same action altogether. What are trading fees, right? So, I mean, some institutions will say free trading, right? Okay, fair, but is it free? Is it in the terms and conditions? Does it state that, right? I mean, it's important to ask that question. What if there's a margin that they're charging? So instead of you buying the stock at market price, maybe there's a little bit of a premium that's being applied to it, right? Are there any custodian fees or brokerage fees? What are the FX fees, right? Maybe sometimes it might be more cost effective to do the conversion yourself versus letting the institution do the conversion for you. Collection fees, funny enough, I never knew what it was called until I joined Sarwa. I have seen it, and I just don't know what to label it. But essentially, sometimes out of convenience, we'll say, hey, I want to pay my monthly premiums into my investment through my credit card. Just it's more convenient, and I get the point. So it's like a win-win scenario. The problem is that most institutions will pass on the merchant fee onto you. So that merchant fee sometimes could be between 2 and 3%. So essentially, you're losing 2 to 3% on your deposit every single time you use your credit card. So it's important to pay attention and just double check that these fees are not being applied to you. So that is how I'd like to wrap up rule number 3. Ask those questions. Costs matter. I think it's, the more you pay attention to the bottom line, the more it'll take care of you. On to you, Akshay. Oh, you're on mute.
Sorry for that. Okay. Thank you very much, Eamon. So we're going to be moving on to rule number 4, which is managing your expectations. Now, rule number 4 is our last one. So please, if you have any Q&A, any questions, just put them in the Q&A function. We're going to be moving on to that after this rule. And I think, look, this rule is great because it's really important, especially now when markets are quite volatile. So it's all about, trying to manage your expectations, managing your emotions as an investor. So I think this is a really good illustration of what most investors go through. And this is actually what we call the investment roller coaster, right? So as you can see, it's a bunch of different emotions that investors go through during their investment journey. And it actually mirrors, economic and business cycles quite well. And I think with a lot of investors, they actually tend to invest on fear, on greed, and these tend to be, some of the biggest drivers for why people sell and buy, so different stocks. And unfortunately, a lot of people tend to buy actually when markets are high and sell when markets are low. In an ideal world, you want to be doing the complete opposite of that, right? Buying low, but then selling high. And often, we hear in the media or from friends or, from whoever it might be, that certain stocks are performing really well. Whether that's maybe, Apple or Microsoft, Tesla, whatever it might be. But by the time you as an investor actually buy the stock, it's reached what's called, the point of maximum financial risk. So you can see that over there. It's under euphoria, or sorry, it's above euphoria. That's normally when you as an investor feel really good about the investment that you're making. You're tempted to buy a little bit more. But what ends up happening inevitably, as all markets, do, and all stocks do at certain points in time, markets fall. And then investors start to question their decisions. You might enter a sense of denial, which might turn into panic. And in this panic, a lot of people end up actually selling their investments. And that's when they realize a loss. But in reality, this is actually what's called the point of maximum financial opportunity. And this is an opportunity for a lot of people to actually invest. And an example that I'm going to use is, look, think about it as being a consumer, right? Let's say if you as a consumer, every single week you go into a grocery store and you buy a can of beans. Let's say that can of beans costs 10 dirhams, and week after week, you consistently buy that can of beans for 10 dirhams. Now, all of a sudden, you go into the same grocery store as you always do, and you see that that can of beans is now selling for 6 dirhams. As a consumer, you're not going to wait to, for the can of beans to go back to 10 dirhams. So you're going to buy them on a discount at 6 dirhams. And that's the way that you kind of want to be thinking about your investments, right? Buy them on a discount if you have the opportunity to do so. And I understand that it's a lot easier said than done when you're using, a discounted can of beans. But it's I guess what I'm trying to say is that our emotions get the better of us, right? When you are investing. And in reality, it's almost impossible to consistently predict, how the markets are going to perform. And that's why it's really important to just try to have a financial plan in place, right? Ride this emotional roller coaster, right? Ride the wave regardless of what's actually happening, because short-term volatility is part and parcel of investing. But when you actually look at how markets perform over longer periods of time, as we showed in rule number 1, that's really the benefit, and that's when you can sort of reap that reward. Now, just going on to this slide over here, this slide is actually taken from a study by Morningstar. It's called the Mind the Gap study, which actually measures how investors' actual results stacked up against total investment fund returns. Now, what I'm going to do is distinguish the bar on the left, which is investment returns, with the bar on the right, which is investor returns. Now, the bar on the left, that represents a very simple buy and hold strategy of certain assets. The bar on the right, that represents actual investors, such as me or you, who've actually invested in the same assets as the bar on the left, but actually had the opportunity to buy and sell at different moments in time based on kind of trying to time the market. Now, you can see that there's something called a behavior gap. And that behavior gap actually stems from poorly timed purchases and sales of the actual investments. And that actually costs the investors, right? As you can see, because the investment returns are higher. Now, this study is actually conducted on a yearly basis, right? Each year, they find that the investment returns, so the bar on the left, actually outperforms the investor returns, because trying to time the market and outperform the market on that consistent basis is very challenging. Investors, they simply don't stay the course and they let their emotions take over. But in reality, if you just leave your funds alone, stick to your plan, that's when you actually reap that investment reward. And so what I wanted to do over here is just go through some investment behavioral biases, because on a day-to-day basis we actually see these really, really often, and they're actually so important because they actually drive markets for the way that these biases act. So what I'm going to do is identify these biases and actually identify ways to avoid them as well. So the first one is loss aversion bias, right? And this is based on investors who actually fear losses more than they value gains. And that actually makes them actually choose more conservative investment choices, and they actually avoid taking some risk. Now, a really good way to avoid this is by setting very clear, rational investment goals, sticking to your investment plan, and just trying to reduce any emotional reactions to short-term losses. Now, the next one is the herd mentality bias. And I think this is probably the most common investment behavioral bias that we see. And this is all about following the crowd, right? Investors who follow the crowd, they hear things that everyone else is doing, and they make all of their investment decisions based on these things. Now, a good way to avoid that is by doing your own research as an investor and basing your investment decisions on your own individual circumstances, as opposed to just blindly following the crowd. And the last one is the recency bias. And I think this is also very key. It's something that comes up all the time, where investors actually give more weight to events that have happened more recently, right? And that actually tends to lead to poor investment decisions. And a good way to avoid this is by just maintaining that long-term investment approach, right? Avoid making decisions based on short-term market movements, because if you're making decisions based on things that have already happened, you're too late to the party, right? So you need to think about markets in their entirety and have that long-term approach. Now, right, we've talked, I guess, a little bit about what these different I guess the problems about behavioral psychology and investing, but some practical advice on how to actually, I would say, calm your nerves when it comes to investing, right? And so we always like to give these 5 tips to clients when we speak with them, right? And the first one is take a breath and don't panic. I know that seems, quite straightforward, but a lot of times people rush into their investment decisions based on things, as we said, that have happened. It's important to take a moment, reflect on what's been going on in your portfolio and not to panic, right? The second thing is remind yourself of your goals. Everyone's investment journey is going to be bespoke to themselves. It's going to be catered to your own goals and your own objectives, right? Make sure that you remember exactly why you started investing, and always keep that at the forefront of your investment journey. The third thing is reviewing your investment strategy, right? It's very important to review your strategy on an ongoing basis just to make sure that it's in line with, the original goals and objectives that you set up. And the fourth thing, very, very key, stop checking your portfolio. I know that seems almost like counterintuitive to say, but it's really important to not, constantly look into your portfolio. Just by doing that, it's not going to change, the outcome of the markets. And the fifth and final thing would say is to try to speak to an advisor. A huge part of my job and Eamon's job is honestly behavioral coaching. It's talking with clients about their goals, their objectives, and how to really make sure that their investment strategy is tailored to that. I think often just having that sort of ear to kind of discuss these things with makes a huge difference. So I definitely recommend speaking to an advisor if you have the opportunity to do so. And to round off rule number 4 and our 4 rules, there's a quote over here at the bottom which I really like. It's investing is like a bar of soap. The more you handle it, the smaller it gets. And the reason why I love this quote is because it is, as I said before, right, it's so key to not basically tinker and tweak with your investments, because more often than not, when you do this, it actually tends to underperform the overall market. So that is, the fourth and final rule number 4 in managing your expectations, and the sort of end of the presentation. So right before we go into the Q&A, I wanted to just highlight, a little bit of a summary on how Sarwa actually applies these 4 rules. So when we're looking at rule number 1 and starting now, right, at Sarwa, we actually have low minimum investment amounts, and the whole journey is actually 100% online, and it's super rapid in terms of opening the accounts, right? So there's no need to go in person and sign documents or do anything like that. So you're able to start very easily, right? Rule number 2 in diversification, right? We offer quite a diversified product suite. So we have Sarwa Invest, which is managed advisory portfolios, which has globally diversified portfolios, which is all automatic. We've got Sarwa Trade, where you as an investor are in the driver's seat and you can trade, thousands of different stocks as well as ETFs. We also have Sarwa Crypto, where you can buy and sell different cryptocurrencies and also allocate some towards your investment portfolio. And last but not least, we also have Sarwa Save, which is an option for you to earn a higher yield on your cash savings. So, all of these different products, provide you with a super globally diversified way to invest. So it really covers rule number 2 well. Rule number 3, and lowering your costs. So the rule number 3, a good way to lower your costs, and the way that you're able to do it with Sarwa is we don't have any deposit fees. We don't have any withdrawal fees. There's no, sort of exit penalties or surrender fees or anything like that. We've got low management fees as well as low trading fees. And rule 4, with managing your expectations, one of the key things is we've got access to customer service. We have access to wealth advisors such as Eamon and myself. We make financial planning, a key priority, and we love to do these sort of educational webinars and seminars, and we have guest speakers a lot too. We're big believers at Sarwa that the more informed you are as an investor, the easier investment journey will be. So we always recommend, trying to speak with advisors, trying to, attend as many of these, webinars and seminars that you can. But that's it in terms of our 4 rules of investing. I think we can maybe move on to Q&A and see what what the audience has asked so far.
Thanks for that, Akshay. Maybe I'll start us off. Got a question by Anonymous, who said, look, what about people who live in other countries than the UAE? When they look at the expenses that they incur when they're looking to transfer money from, their bank, or maybe using the debit card, and also taking into consideration whatever fees that we pay, they feel like there's going to be little left to invest. Also, this person's a beginner. What are our views on this? And I mean, you hit the nail on the head, Anonymous. I mean, it is. So I'll give it a context. Within the UAE, central bank has made it so that we can transfer money to each other free of cost, right? So, whether I bank at one bank and actually banks at another bank, we can transfer money to each other free of cost. But that's not the same in between countries. So if somebody from Kuwait, Saudi, Qatar, or even UK or any other part of the world was looking to transfer money into the UAE, there's a cost associated with that. And typically that is a wire transfer fee. And that can be quite considerable relative to the amount of money that you're investing. So for example, if you're looking to start your investment journey with $500, right, which is typically the minimum amount to start being invested for Sarwa Invest portfolios, most banks will charge in and around, $40 for a wire transfer fee if you're sending money, across, countries altogether. So that's nearly 10% that you're losing out on fees, just for the ability to transfer money into your investment account. And that is not advisable. I think that neither Akshay or I or any advisors on our team will suggest that as a viable option to continuously use wire, transfer as a method or methodology to transfer money if it's going to cost you that much money. But if that is your only option, since you do live overseas, what I would probably recommend in this case is one of two things. Either A, accumulate your savings in your home country and transfer the money periodically rather than transferring it every single month. And I understand there are benefits to investing as soon as possible. I'm with you, but you've got to make the best out of a situation in this case. And what I would recommend is maybe accumulate the funds in your own personal savings account or deposit account in your respective country and send it then. Maybe it could be on a quarterly basis. It could be on a semi-annual basis. It could be on an annual basis. It's much better from a cost perspective. The second option could be that maybe you send it in bulk into our Sarwa save account, right? So let's just say you have the savings, but you just don't want to start being invested right away, right? You maybe want to, spread out your investment over a period of a year. You can just deposit into Sarwa save and you're earning interest, in that period of time. And you can transfer between your Sarwa save and Sarwa invest at any point in time. And that way you don't incur any charges. So suppose that's a hypothetical, you had $10,000 today that you do want to invest, but you want to invest it over a period of a year, make it an easy number, $12,000, and you want $1,000 invested every single month, until the end of the year. You don't want all of the 12,000 invested all at once. Well, what you can do is send it over to your Sarwa save, let it sit there, it's earning interest anyways, and you can transfer $1,000 into your Sarwa invest account whenever you like, whenever you're ready to participate in the market. That's the second option. There is a third, but essentially I think the second option is best, where we can set up something called a scheduled trade for you, where we can put the money into your investment account, but we can just tell our systems to not invest it until a period of, over a period of a year. So we can do that for you, but I mean, it's probably better to just put it into the Sarwa save. Happy to explore other options with you to see what's most cost-effective way for you. But it's just a matter of just making the best out of the situation until there are mechanisms or mediums or vehicles that allow you to transfer money internationally for a much lower cost or hopefully free. This is unfortunately the status quo for now, Anonymous.
Yeah, I mean, I think you really hit the nail on the head with that one. Yeah, unfortunately, it is, it is challenging, but you don't want to disadvantage yourself by just spending so much on fees on a monthly basis. I think it's also key to note, right? Even if I think option 2 that you mentioned is a really good solution, right? You can obviously transfer to your save account, and then the nice thing is you can also transfer to your invest account, but not only that, you can transfer to your trade account too. So, right, if you want to transfer between the combination of all 3 of them, you can do that as well. So it's nice to use the save account almost, obviously it's great because it has, generous interest that you're able to accumulate on it, but you can also, make transactions between the alternate accounts as well. So I think that's always a good solution. But yeah, so I think we've got another question over here from Anonymous saying that I don't have a monthly income, and because of that, I can't invest every month. My question is it compulsory to invest every month? Yeah, look, really good question. We've got a lot of, I think we've got a lot of clients. We speak to a lot of people who don't necessarily have a monthly income. Maybe they're on a commission, maybe they, they earn a more infrequent salary. And look, it's not a complete requirement. It's not compulsory to invest every single month if your financial circumstances or if your salary doesn't permit that, right? What a lot of people do, who maybe, earn commission or get paid, on a more infrequent basis, they ultimately will maybe calculate everything on a yearly basis, right? We've got some clients who do that, right? They look at, how much they make on a yearly basis, and if they're able to average that out, and then based on that, they can, either transfer money in or invest every quarter, semi-annually, or also every year. It will really depend on what your circumstances are. If you want to also, let's say if you make money in a more lump sum basis, you can also drip that in on a monthly basis, but it doesn't need to be every single month. I think the key is to have some sort of a plan. So whether it's every quarter, whether it's every 6 months, that's also completely fine, right?
Sounds good. Look at we're all out of questions here already. Looks like everybody seems to be well informed and they don't have any questions, or maybe we scared them off. Actually, I'm not sure.
Yeah.
But we did finish on time at 7 o'clock, and we have a habit of sometimes going over on time. Um, Look, folks, we really appreciate you spending the time to join us today to learn about the best practices of investing. We would love to hear your feedback. There's a QR code on screen that takes you directly to our Google reviews page, and we'd love to hear your feedback on how you thought about what you thought about the seminar. And it serves two purposes: for us to learn, how to improve, and also, secondly, to highlight to others the work that we do here. Our greatest, I would say, sources of customers are referrals from existing customers who've really enjoyed our services over the years, who've been really happy with the way that we approach investing and our focus on educating our client base. And no greater way to pay it forward than referring others. So thank you again for everybody. Thank you for joining us. Actually, thank you as well. And I guess have a wonderful evening, everyone.
Yeah, I mean, thank you very much. And thanks all for joining. Really appreciate it. And yeah, have a great evening.